Well, Justin, here we are here again. I think, gosh, the last time I saw you was probably at our ASPAC conference in Singapore, and now we're all working virtually. So you're a partner with KPMG in Australia. You are responsible for our international tax practice and our data transformation and compliance practices. Tell me, what's top of mind for businesses in Australia given everything that's going on today?
Thanks, Rod. Well, I guess there's only one key issue right at the moment, which is all around liquidity. Um, so there's probably some different elements to that for our clients, but the key themes seem to be obviously sourcing working capital and the issues, the tax, obviously a bunch of tax issues that go with that, whether it's equity raising related or accessing credit lines. Accessing government concessions and programs that are being rolled out in response to COVID-19, and also accessing ATO administrative concessions. So the ATO has rolled out a number of, cash type concessions, but also resourcing and some technical concessions as well. So they're probably the sort of three key themes we're seeing at the moment. But again, all rolled off the back of liquidity related issues, and also employment or wage protection elements to that as well, keeping people in jobs. On the government concession side of things, the newest and the largest package that's just come out is the JobKeeper wage subsidy. So that was rolled out 2 weeks ago. There's a lot of detail that's still getting worked through in relation to it. But basically it boils down to a $1,500 per fortnight, so every other week, wage subsidy per employee for up to 6 months. Qualification, there are some eligibility requirements for employers to be able to take advantage of that. And if your aggregated turnover is below $1 billion a year, then you have to be able to demonstrate a 30% decline in your Australian turnover. And if your aggregated revenue, so that's global associate related type turnover, is over $1 billion, you've got to be able to demonstrate a 50% decline in your Australian turnover. So we are seeing not as much applicability across our multinational clients, but definitely some of the smaller clients, and those who are particularly badly impacted in Australia, we're seeing that as well, the 50% threshold being met. There are some capital expenditure concessions as well, some upfront expensing, some accelerated depreciation, but they were rolled out earlier. And with the focus on liquidity, we haven't really seen a big take up in that. People going out and buying new assets is not really happening, just because the cash is needed elsewhere, just for survival. Then there's also some state government payroll tax concessions that are being rolled out as well, waivers or concessions on payroll tax obligations. Then on the ATO side of things, so you can apply for payment, cash tax payment obligation deferrals, lodgement deferrals. There's no blanket deferrals that have come out, but it's on a tailored basis. So you can ring the ATO and you can get those deferrals granted. Resourcing deferrals. So the ATO has said if you're under audit at the moment or some other types of review program, you can ask for that to be deferred. So again, the ATO is not going to use resources at the moment or ask taxpayers to commit resources to what I call business as usual tax compliance obligations. And then we're starting to see some technical administrative concessions come out. And the first one of those is probably related to obviously leverage, so thin cap concessions. So as you know, in Australia, we have a 60% safe harbour threshold, and beyond that, you can rely on an arm's length debt test. With people needing to draw down their credit lines or with asset values having to deteriorating, we are starting to see taxpayers breach that 60% leverage threshold. So that's 60% of gross assets. So the ATO has said, look, if you're pushed because of COVID-19 occurrences into an arm's length debt test scenario, we will apply a more concessional approach than the law currently provides. They're saying, for example, we're not going to dedicate compliance resources to reviewing your arm's length debt test compliance beyond confirming that you are actually what gave rise to the COVID-19 occurrence. So if you've had to draw down more third-party debt, or if your assets values have deteriorated for book purposes and it's a short-term period, then they're not going to spend a lot of resources on that. If it's out beyond 12 months, they're saying, well, we would expect that would be drawn down as equity in a related party scenario as opposed to debt. So once you get out of sort of the third-party debt or the asset revaluation scenario into related parties, so in a multinational scenario, then they'll be looking at it a little more closely. But again, if it's a short-term response, we would expect not to have a lot of compliance resources allocated to reviewing this for the current year, and potentially early into the new year as well. They're probably the main things that we're seeing at the moment that have come out. As I said, the JobKeeper wage subsidy is the big one right now. And then just from an activity perspective, projects that clients were focused on before COVID-19 occurred, most of them are going through to completion at the moment. We're not seeing that activity drop off, but new projects are being put on hold at the moment. Our resources are getting reallocated, to where they're required from a liquidity perspective. And some of the larger organisations are also starting to put holds on, consultant spend and advisor spend as well.
So kind of interesting, Justin. I mean, the picture you paint is just for folk that have Australian businesses or operations in Australia. There's actually quite a lot in terms of programs to help improve liquidity. The JobKeepers program you mentioned, state tax applications for deferrals of processes, and this relaxing of an approach to thin capitalization is also very welcome. So must be keeping you extremely busy at the moment.
It is definitely a lot of activity at the moment. A lot of those haven't yet translated into existing or ongoing opportunities. People are trying to wrap their heads around a lot of new measures and a lot of new regulations. People are scrambling as to the detail behind it, and not just on the taxpayer side, but also in the tax office side. The legislation that was drafted sort of set out the principles, but it was left to regulation and to administration as to how it would operate in practice. So there's a lot of resources, even within the ATO. We submitted a ruling request the other day on a completely different matter, but a capital markets related matter, to the early engagement group at the ATO. And notwithstanding the title and notwithstanding they're usually quite responsive on market sensitive matters, they've said there will be a delay because a lot of people are being reallocated, for example, to the JobKeeper wage subsidy program.
Gosh, well, maybe that's a place to draw our discussion to a close, because certainly if that's where the ATO is starting to devote resources, that means if our clients aren't thinking about whether they can access these programs, they really ought to take a step back and refocus on that sort of opportunity right now.
Definitely. Thanks for your time, Rod.
Well, thanks for your time, Justin. Good to see you.